What if the metal sitting quietly in your drawer just became your most powerful financial tool? Silver just crashed below $70 an ounce, a 10% drop in a matter of days. And most people have absolutely no idea what this means. Some are panicking, and some are selling everything. But a small group, the ones who actually understand how this market works, they're doing something completely different. Something that, on the surface, looks unthinkable. Here's the thing nobody is telling you. This drop, it might be the most important setup of 2026, or it could be the beginning of something much darker. I've spent the last 72 hours deep in the data, the supply reports, and the institutional flow numbers, and what I found genuinely shocked me. There are forces at work in the silver market that Wall Street does not want you to understand. There's a plan forming, and if you're not positioned correctly, you will miss it entirely. By the end of this video, you'll know the real plan. You'll know why 2026 could change everything for silver holders. And I'll show you exactly how I'm positioning my own money right now. Stay with me. This is the most important silver video I've made all year. Let's talk about what actually happened. In March 2026, silver dropped from roughly $77 down to the $68-73 range. That is a 10% plus collapse in a very short window. On some sessions, silver was seeing daily moves that most asset classes don't see in a month. Now, on the surface, people are blaming macroeconomic pressure. Rising dollar strength, shifting Federal Reserve tone, equity market volatility, pulling money away from commodities. And yes, those factors are real, but they don't tell the full story, not even close. Here's what's actually happening beneath the surface. The paper silver market, meaning futures contracts and leveraged ETFs, is roughly 100 to 300 times larger than the physical silver market. Let that sink in. For every real ounce of silver that exists above ground, there are potentially hundreds of paper claims on that same ounce. When institutional players want to push the price down, or when margin calls start triggering, they don't sell physical silver. They dump paper contracts, thousands of them, at the same time, and the price craters. This is what many analysts call the Wall Street paper game. And right now, in March 2026, you are watching it happen in real time. The gold to silver ratio has now widened to above 67. That means it takes over 67 ounces of silver to buy just 1 ounce of gold. Historically, that ratio averages much closer to 40 to 50. When this ratio spikes this high, it signals one of two things. Either silver is massively oversold and due for a powerful rebound, or something systemic is breaking and deeper pain is coming. I'm going to show you which one this is. But first, understand this. Institutional de-risking is happening aggressively right now. Big funds are trimming commodity exposure. Algorithmic traders are piling on the short side, and retail investors are the ones left holding the bag, confused, frightened, and making emotional decisions. Don't be that person. The setup here is more complex than the headlines suggest, and the opportunity, if you know where to look, is extraordinary. Let's start at the macro level. Global debt has never been higher. The United States alone is now carrying over $36 trillion in national debt. Central banks around the world have been printing money at a pace that would have seemed impossible a decade ago. What does that mean for hard assets like silver? It means the real value of paper currency is being slowly eroded. Every new dollar printed makes your existing dollars worth slightly less. Silver, like gold, is a finite physical resource. You cannot print it. You cannot manufacture it out of thin air. And here's what's accelerating this trend in 2026, de-dollarization. Countries like China, Russia, India, and large parts of the Middle East are actively reducing their dependence on the US dollar for trade settlement. They are building alternative payment systems. They are accumulating physical commodities as reserve assets. Silver is part of that equation. When the dollar loses its dominance as the world's reserve currency, and that process is already underway, hard assets will see a massive repricing. The current dip in silver, it could look like a gift in hindsight. Now here's the part of the silver story that almost nobody in mainstream finance is talking about. Silver is not just a monetary metal. It is the most electrically conductive element on Earth, and the industrial demand picture for 2026 is nothing short of explosive. Solar panel production requires silver paste for conducting electricity. Global solar installation targets are accelerating at record pace. The International Energy Agency projects solar capacity to more than double before 2030. Each gigawatt of solar capacity requires millions of ounces of silver. Then there's artificial intelligence. AI data centers are multiplying globally at a staggering rate. Semiconductor manufacturing, the chips that power AI, require silver in the bonding and coding processes. The more AI expands, the more silver gets consumed, and it doesn't come back. Unlike gold, most industrial silver is used and lost forever. It ends up in landfills, circuits, and solar panels, non-recoverable. This is a structural demand story that the futures market is completely ignoring right now. And that gap between paper price and industrial reality, that is your opportunity. Let's talk supply. Silver mine production has been flat to declining for several years. Major silver producing nations, Mexico, Peru, Bolivia are all dealing with geopolitical instability, labor disputes, and rising extraction costs. New mine development takes 10 to 15 years from discovery to production. There is no fast fix for a supply shortage in mining. Meanwhile, the Silver Institute has reported above-ground silver inventories at multi-decade lows. The COMEX, the main U.S. futures exchange, has seen registered silver inventories drop sharply over recent months. When physical supply tightens while paper selling drives prices down, you get a dangerous disconnect. And historically, those disconnects resolve violently to the upside. Add geopolitical risks, trade tensions, supply chain disruptions, and resource nationalism from major mining countries, and you have a supply picture that should make every silver analyst deeply nervous. The market is not pricing any of this in right now. That is either a major warning sign or a major entry point. Where does silver go from here? I want to be straightforward with you. Nobody knows with certainty. Anyone who gives you an exact price target with total confidence is oversimplifying. But here's what the data and historical patterns suggest. If silver holds the $68, $70 support zone and bounces, the next key resistance levels are $80, then $88, $90. If industrial demand numbers accelerate as projected, and if the gold to silver ratio begins to normalize back toward 50, silver could be looking at $95 to $110 before year-end 2026. That is not a fantasy scenario. That is what the fundamentals support if institutional sentiment shifts. On the downside, if macro conditions deteriorate severely and deflation fears take hold, silver could test $60. That level has strong long-term historical support. But here's my personal read. The risk to reward at current prices, $68 to $73, is among the best I've seen in the past 2 years. The downside is limited by industrial floor demand. The upside is being suppressed artificially by paper contracts. And artificial suppression cannot last forever. This is the most important distinction you need to understand. Paper silver, ETFs, futures contracts, certificates gives you price exposure. But you do not own silver. You own a promise made by a financial institution. That promise is only as good as the institution behind it. And in a systemic financial crisis, the kind of event that historically makes silver prices surge the most, those paper promises can be delayed, restricted, or broken. Physical silver, coins, bars, rounds held in your possession, or in allocated storage, is yours. No counterparty risk, no broker can freeze it, no bank can restrict your access to it. The difference between paper and physical silver has never mattered more than it does right now. If you're holding paper and the system breaks, you may be left with nothing when silver is at $150. If you're holding physical, you're holding real wealth. So here's the plan. The one I hinted at in the intro. The one the institutional players don't want individual investors to figure out. The plan is simple, but requires discipline. When paper markets artificially suppress silver prices through mass futures selling and institutional de-risking, smart money does not panic sell. Smart money acquires physical metal at a discount. They let the paper players exhaust themselves. They wait for the physical market to reassert its reality, and then they hold. The plan has 3 phases. Phase 1, identify genuine support levels in the $68, $73 range. Do not try to call the exact bottom. Nobody can. Instead, build a position in stages. Phase 2, hold physical silver outside the banking system while the macroeconomic picture unfolds. Watch the gold to silver ratio. When it starts compressing, when silver starts outperforming gold, that's your confirmation signal. Phase 3, if industrial demand data for solar and AI continues to strengthen through mid-2026, increase conviction in your position. The catalyst for the next major move could be a single large COMEX delivery failure, a currency event, or a supply shock from a major mining country. Any one of those could trigger a rapid repricing. You want to already be positioned before that happens, not scrambling to buy at the top. Let me give you practical steps you can take right now. Number 1, buy physical silver from reputable established dealers only. Do your due diligence. Check reviews, verify pricing premiums, and confirm they have verifiable inventory. Don't chase the cheapest price. Chase reliability and authenticity. Number 2, diversify your form of physical silver. Consider a mix of recognized government-minted coins, like American Silver Eagles, Canadian Maples, or Britannia coins, alongside standard cast bars from established refineries. Coins carry slightly higher premiums, but have better liquidity in a crisis. Number 3, practice strict risk management. Do not put money into silver that you cannot afford to have locked up for 12 to 24 months. This is a medium to long-term position. Do not leverage. Do not use borrowed money. Silver held without debt is wealth. Silver held with leverage is stress. Number 4, stay informed. Follow supply and demand data from the Silver Institute. Watch COMEX registered inventory levels monthly. Track the gold to silver ratio weekly. These are your real indicators, not the daily price noise. And join a community of informed long-term thinkers, people who are staying ahead of these market moves, not reacting to them. That's exactly what this channel is building. Hit subscribe and join us. Let's bring it all together. Silver dropped over 10% in March 2026. It hit the $68-$73 range. The gold to silver ratio stretched above 67, and on the surface, it looks like a disaster. But when you look at the industrial demand picture, solar, AI, semiconductors, the supply deficit, the currency debasement trend, and the historic pattern of paper suppression being followed by physical repricing, this looks like a setup, not a guarantee, but a setup with compelling risk to reward. The key levels to watch are $68 support on the downside and $80 resistance on the upside. If silver holds and begins to close above $75 to $77 on a sustained basis, the next move could be powerful. And if the macro environment shifts, dollar weakens, industrial demand data surprises to the upside, or a supply shock hits, 2026 could be a transformational year for silver holders. Stay patient, stay informed, stay physical. In my next video, I'm going to break down exactly which silver products offer the best value right now. Coins versus bars, premium analysis, and which dealers I personally trust. If this video gave you clarity, value, or a new perspective, please hit the like button right now.